Okay, good morning and welcome to this BSA BDO seminar or webinar, distanced. I'm Jeremy Palmer, Head of Financial Policy at the BSA, and I'm introducing this webinar today, but the hard work has been done by Mark Spencer, who is the Accounting Advisory Leader at BDO, who is presenting this morning, and also behind the scenes by Lauren Hughes, who is running the techno side from BDO. First of all, if you are hoping for a relaxing hour of Netflix, you have got the wrong channel. This is Accounting for COVID-19, and we are all here to work. Now, during the current lockdown in England, we're very pleased to be able to continue with these webinars. As you can see, we are broadcasting from secret and socially distanced locations, and we hope you and your teams and all your families are safe and well. Just a few housekeeping things before I hand over to Mark. So I was going to say in allo style that you should listen carefully because Mark will say this only once. But in fact, the webinar will be recorded and we will then, after they've been prepared for being put on the website, probably in a few days, up to a week, we should have them available in the members area of the BSA website. So you'll get the slides and you'll be able to listen again to the actual webinar. We've got about 70 to 75 participants this morning. So you can imagine it's necessary that all the participants stay muted throughout the webinar. Sorry about that. Otherwise, I'll be saying don't all shout at once. So to ask questions, which you can do at any time, you don't have to save them up. If you look at the bottom of your screen, there should be a button that says Q&A, and you use that and you send the questions through, and I will pick them up and put them to Mark, and Mark will see them as well. If you have any problems with the techno side or the sound, just use the chat function to let Lauren know that there's a problem, and she'll do the best she can to sort it out in real time. So with that brief introduction, thank you all again for joining us this morning. I hope you have a really interesting and useful time. I think it's going to be a pretty packed agenda, so I'll shut up and hand over to Mark. I'll step back and you'll see my alter ego red panda appearing. So over to you, Mark.
Jeremy, thanks. Good morning, everybody. I'm Mark Spencer, and I lead our Financial Services Accounting Advisory practice at BDO. First of all, thank you from me for joining us today for this webinar. And thank you from all of us at BDO. Financial Services Accounting Advisory at BDO spans all aspects of accounting and financial reporting across 5 pillars: accounting change, structuring advice, financial instruments accounting and reporting, climate and corporate reporting, and all other areas of accounting. One thing that the Financial Services Accounting Advisory team at BDO has been doing since the onset of COVID-19 is engaging with financial reporting and prudential regulators in the UK and the EU, trade bodies such as the Building Society Association, our peers in terms of audit firms both locally and internationally, and other parts of the wider community on the implications of COVID-19 on financial instruments, accounting and financial reporting. Next slide, please. In terms of agenda, for the time that we have today, we're providing some context on the impact of COVID-19 in terms of accounting and financial reporting. We will then focus on some general considerations on the implications of COVID-19 on financial instruments accounting and financial reporting, and we will also look at the PRA's pronouncements of the 26th of March, the 2nd of June, and the 28th of August. Next slide, please. In terms of context, COVID-19 has unfortunately had an adverse impact on a large number of the world's economies. This will impact lenders differently depending on, for example, the location of their borrowers and the sectors that they operate and work in, with such impact being reflected in the financial statements. This requires a distinguishing between what is to be reflected in the financial statements in terms of recognition and measurement, and what is considered to be a post-balance sheet event. Given this is such a dynamic situation, this exercise of distinguishing between what is to be reflected in the financial statement in terms of recognition and measurement, and what is considered to be a post-balance sheet event needs to be considered as at each reporting date. Next slide, please. Under UK GAAP, preparers have an accounting policy choice in terms of how they account for their financial instruments. In terms of recognition and measurement, one can either apply sections 11 and 12 of IFRS 102 or the recognition and measurement requirements of IAS 39 or the recognition and measurement requirements of IFRS 9. And while most of the pronouncements issued by, for example, the PRA specifically speak about IFRS 9, insights can still be derived from them in terms of applying IAS 39 and sections 11 and 12 of IFRS 102. This is particularly relevant for building societies, as I understand that a number of you apply either IAS 39 for the recognition and measurement of financial instruments under UK GAAP or sections 11 and 12 of IFRS 102. Therefore, as we work through this presentation, I will be highlighting areas where the insights are also relevant to IAS 39 or sections 11 and 12 preparers to some extent. With this being marked on your screens now, and each slide of this presentation, where IAS 39 and sections 11 and 12 may be relevant. I will be also drawing your attention to this as I talk through the slides. As one can see, other than slides 6 and 7 and 18, inferences can be derived for IAS 39 and sections 11 and 12. Please note that this slide pack will be made available after this presentation. And please also note that under IFRS 102, while you have an accounting policy choice in terms of the recognition and measurement of financial instruments, the presentation and disclosure requirements of IFRS 102 will always apply, not those of IFRS. So, to summarize, if your building society is an IFRS preparer, then you will be applying IFRS 9 to your accounting for financial instruments, with one exception, which is potentially hedge accounting, that I will talk through in a bit. If you are applying UK GAAP or IFRS 102, then when it comes to the recognition and measurement of financial instruments, you can apply either those requirements of section 11 and 12 of IFRS 102, or those recognition and measurement requirements of IFRS 9 or IAS 39. And throughout this presentation, we will be taking pauses to see if there are any pertinent questions from the audience, and we'll also be taking questions at the end. And this is one of those points at which I will just pause to see, Jeremy, if we have any questions from the audience.
Not at the moment, Mark. No questions received yet, but it's early days, so please continue.
Okay, thank you, Jeremy. Next slide, please, Lauren. The PRA has written to lenders on the application of IFRS 9 given COVID-19. While these letters and statements focus on the forward-looking elements of the IFRS 9 expected credit loss model, parts thereof can be applied to IAS 39 or sections 11 and 12 of IFRS 102 when it comes to incurred credit loss models. For example, actions to support borrowers may not necessarily automatically give rise to default under these two latter standards. This applies to both individual assessments, say for corporate or larger SME loans, and collective assessments for smaller SME loans and retail and consumer credit portfolios. COVID-19 induced forbearance is to be assessed as to whether they are indicative of credit deterioration or a lack of short-term liquidity. Credit risk exposures that were on the edge of default before the onset of COVID-19 are more likely to now be considered as being credit impaired as a result. We will talk through the PRA's letters and statements later on in this presentation. Classification of debt assets under IFRS 9 is based on the interplay between business models and the outcome of the contractual cash flow test. On the latter, COVID-19 does not impact whether the cash flows solely represent payments of principal and interest. This test is done at initial recognition and not reassessed as a result of market changes. On business models though, IFRS 9 does state that a change in business model is expected to be very infrequent and will occur only when an entity either begins or ceases to perform an activity that is significant to its operations. An example in IFRS 9 contemplates infrequent sales resulting from unanticipated funding needs, specifically in a stress case scenario, and the conclusion is that this would not contradict a hold to collect objective, even if such sales are significant in value. Classification under IAS 39 and sections 11 and 12 of FRS 102 should not change either. That is to say, it is determined at initial recognition based on consideration of all of the contractual terms and conditions as at the point in time that the financial instrument is originated, held, written, or issued. There are increased instances of borrowers requesting lenders to modify the terms of a loan contract, which can take various forms. For example, reduced interest rates, payment holidays, and covenant waivers. IFRS 9 and IAS 39 and sections 11 and 12 of FRS 102 have broadly similar requirements for modifications, where this may need to be assessed in both qualitative and quantitative terms as to whether the financial instrument is a new one or a modified one. It is envisaged that a fair number of contractual modifications will not be to the extent that the original financial instrument is derecognized and a new financial instrument is recognized. This is given the nature of the contractual modifications to loan agreements that are arising as a result of COVID-19. It is to be said, though, that losses are still expected to arise in lenders' financial statements when the contractual terms of financial assets are modified, as the modified carrying amount is likely to be lower than the original carrying amount due to the deferring of cash flows and or reducing of interest rates, with this loss being recognized in profit or loss. There is a need to distinguish between deferring and suspending interest, given the implications thereof in terms of repayment. And this is all dependent on facts and circumstances and how the terms and conditions of financial instruments are being contractually modified. One point on hedge accounting: forecast transactions under a cash flow hedge may no longer be highly probable, which would give rise to increased ineffectiveness, or may not be probable, which would give rise to hedge discontinuance and recycling of the cash flow hedge reserve. Remember, under IFRS 9 or FRS 102 for that matter, one can still apply the hedge accounting requirement of IAS 39. The ISB has allowed this until the dynamic risk management project is completed. Another point on hedge accounting is that, under IFRS 9, a preparer is not allowed to voluntarily discontinue hedge accounting. It would therefore need to rebalance so as to maintain the hedge ratio. This would involve taking out more or less of the hedging instrument and or hedged item. Under IAS 39 and sections 11 and 12 of FRS 102, you can, though, have voluntary discontinuance. So it very much depends what you are applying. And remember, you could be applying fair value hedges of the interest rate exposure of a portfolio of financial instruments under IAS 39 and designating all other hedge accounting relationships under IFRS 9. Next slide, please. We will now turn our attention on ECL accounting under IFRS and related matters, with a fair amount of this being equally applicable to incurred loss models under IAS 39 and sections 11 and 12 of FRS 102, and I will signpost these as and when such considerations under IAS 39 and sections 11 and 12 of FRS 102 come to light. First of all things being equal, there is an expectation that the ECL will increase. This is due to either the risk of the borrower defaulting increasing and/or the amount the lender would recover under any credit risk mitigation strategy decreasing. With this being true at face value for any credit risk mitigation strategy, that is to say, work out, repossess and sell the collateral, or sell the loan itself. With this being equally applicable under IAS 39 and sections 11 and 12 of Ifrs 102, in the sense that the recoverable amount is expected to be lower when estimating impairment. IFRS 9's general approach to impairment, which applies to loans advanced, loan commitments, and financial guarantee contracts, require 12-month ECL to be estimated for those credit risk exposures that are in stage 1, with the 12-month probability of default that is applied to those being more prone to increased volatility given the increased uncertainty. COVID-19 may trigger a significant increase in credit risk that results in the credit risk exposure moving from stage 1 to stage 2, meaning that lifetime ECL will need to be estimated. ECL also applies to financial guarantee contracts, which are contracts under which the issuer makes specified payments to reimburse the holder for a loss because a specified debtor fails to make payments when due to the holder. And COVID-19 may impact both third-party financial guarantee contracts, for example, letters of credit, bank guarantees, etc., and related party financial guarantee contracts, for example, cross guarantees between a parent and its subsidiaries or between subsidiaries. This is in light of the increased likelihood of the specified debtor failing to fulfill its performance obligations. Before we move on, it is worth remembering that IFRS 9 is a principles-based standard that does not prescribe when a significant increase in credit risk arises or how forward-looking multiple macroeconomic scenarios are to be determined. This gives rise to the need to apply judgment. And the application of IFRS 9 in judgment in fact requires lenders to adjust their approach to assessing significant increase in credit risk and estimating ECL when circumstances change. An example of this is because the relationship between macroeconomic variables to ECL parameters may no longer hold or provide intuitive results. Another thing worth bearing in mind is that 30 and 90 days past due as indicators of significant increase in credit risk and default are rebuttable presumptions, and it may be appropriate to rebut them if evidence supports this. This is because the primary indicator of a significant increase in credit risk is a relative, unexpected increase in the probability of default over the credit risk exposure's contractual life. Next slide, please. IFRS 9 is based on assessing and measuring changes in credit risk over the contractual life of debt assets. There is information out there with banks and rating agencies publishing this. An undue cost or effort does not mean no cost or effort. The information needs to be reliable and relevant. That is, do not just go to an outlier in terms of availability if there are questions over its reliability. The whole picture needs to be taken into account, and while borrowers are generally worse off with credit risk increasing, governments have introduced various fiscal measures to protect the economy. This will inevitably give rise to macroeconomic scenarios as well as their associated weightings being changed and calibrated over time. For example, we are seeing more severe downsides being implemented and weightings skewed towards those downsides in total when compared to the base and upside scenarios. However, it is acknowledged that models cannot be recalibrated that quickly, so it is accepted that some of this will be reflected by post-model adjustments and overlays. Post-model adjustments and overlays can be affected to inputs and assumptions, parameters, probability weights, and model output, with parameters being the exposure at default, probability default, and loss given default. These are sometimes used when it comes to data, as in post-model adjustments and overlays are sometimes used when it comes to data, given the economic consensus can lag public sector intervention. We would therefore advise to use information that is available on or around the reporting date, but not too much after that. Say the first week of December only for a November period end and not the end of December 2020 or the middle of January 2021, as the latter, i.e. the end of December 2020 or the middle of January 2021, may include factors that actually arose after the 30th of November. Furthermore, these post-model adjustments and overlays will be updated as new information comes to light, and they need to be substantiated. We will return to the use of post-model adjustments and overlays in a few slides' time. When we do, please bear in mind that post-model adjustments and overlays are also affected to incurred credit loss models. Under IAS 39 in sections 11 and 12 of FRS 102, this is as incurred loss models may not necessarily capture all risk factors. And remember, IFRS 9's raison d'etre is to provide users with insights of where the entity is in terms of the credit cycle, and increased transparency is needed on uncertain times. This would be achieved through adhering to the requirements of paragraphs 122 and 125 of IAS 1, or paragraphs 6 and 7 of section 8 of FRS 102, which are qualitative and quantitative disclosures around critical accounting judgments and source of estimation uncertainty, as well as IFRS 7's and section 34 of FRS 102's credit risk disclosures. Although it is acknowledged that there is a challenge to ramp up disclosures given resource constraints, but it is hard to make meaningful comparisons without granular disclosures. Next slide, please. As I said at the start of this presentation, there is an expectation that there will be a large number of defaults and losses as a result of COVID-19, with the quantum and timing thereof remaining a bit uncertain. And this is not dependent on whether one is applying IFRS 9, IAS 39, or sections 11 and 12 of FRS 102. Defaults, payments holidays, and losses will also, in terms of basic conceptual principles, impact IAS 39 and FRS 102 incurred loss models in similar ways. However, actual defaults to date are limited, giving government assistance and economic support measures. But the risk of insolvency is increasing, with a number of entities in discussion with their lenders, other possible lenders, governments, and advisors, with the outlook for certain sectors of corporates being bleak. However, retail portfolios are less clear given impacts of second-order effects to an extent. In anticipation of the possible adverse economic impact of COVID-19, there was an increase in credit losses in Q1. Government assistance and economic support measures then kicked in more fully, which has resulted in credit losses remaining relatively stable for Q2 at a macro level. I say macro level as increases in Q1 have been retained, given a dimmer outlook at Q2 that is offset by more government measures being in place to the extent that they could be captured in credit loss calculations. For example, payment deferrals are in place and days past due are not kicking in yet, with the result being under IFRS 9, lifetime ECL is not being recognised for those credit risk exposures that did not move to stage 2, and only some losses being recognised for payment deferrals. On the retail front,
Mark, can I just ask you a quick
Sure.
question, just
Sure.
a sort of very general one, and appreciate it's difficult to give more than a very high level kind of generalized answer. It sounds from what you're saying on this slide and the whole question about how things progress between Q1 and Q2 and onwards, that some of the effects of the measures will have deferred but not necessarily mitigated the ultimate hit. So maybe, being colloquial for a moment, what it's really done is to kick the can down the road. Is that a fair oversimplification?
I think to an extent it is, Jeremy. I mean, because, and we'll see it later, and this will come to light as we talk through. Um, by the PRA have said, look, in terms of counting days past due, it's from the revised payment schedule. So it's a case of, look, when you've given a holiday to a consumer for their mortgage, and it's 90 days, the PRA have been quite clear, and I agree with this, that the counting of days past due starts from when they're past due from the revised payment schedule. So it's a case of it would start counting from then. I mean, as I said, you'd recognize a degree of loss because of the time value of money. So if you're not adjusting the interest rate, and I'm not really aware of borrowers who are adjusting the interest rate, then there may be a small loss recognized as you revise the cash flows because they're deferred by 90 days or 180 days on the assumption that the person is on a second payment holiday. So I think that there is an element of colloquially to kick the can down the road. And another factor that comes into mind there is the government support measures. I mean, to the extent that furlough continues and other government support measures continue, then businesses very colloquially and very unfortunately and very bluntly are being propped up to a fair extent. So that's another factor to bear in mind. But there is general consensus that losses are coming. And unfortunately, as for example, when we now come off furlough in March or April, that some entities would just become insolvent, unfortunately. And that would have impact on consumers. Does that answer the question,
Yeah.
Jeremy?
Yeah, that's great, thanks.
And then on that vein, on the retail front, the subsequent deferrals are reducing, so more care needs to be exercised. Also, removal of economic support measures will impact both corporate and retail books, with there possibly being more modifications that give rise to derecognition as they are more tailored to customer circumstances, and more troubled debt restructuring arising as a result, with the re-recognized loan being re-recognized as originated credit impaired, for which lifetime ECL will always be recognized under IFRS 9, and it is envisaged that there will be write-offs associated with such troubled debt restructuring under IFRS 9, IAS 39, and sections 11 and 12 of IFRS 102. Next slide, please.
Mark,
Yes.
I've had one question from the audience,
Of course.
which I think is highly relevant to exactly where we are now. So if you don't mind, I'll ask it now rather than saving it up.
Sure.
So the question is a really good one. Shouldn't we be looking at essentially the accounting standards rather than PRA guidance on our bad debt provisions? Because currently they don't seem to correspond exactly.
I'm not entirely sure I understand the question. I mean, we are looking at accounting guidance and requirements.
Mm-hmm.
I mean, but the benefits of looking at the PRA has discussed their letters and statements with the ISB. And they have reached a view as well that any guidance that they have issued does not contradict what IFRS states. We need to bear in mind, as I believe I said earlier, that IFRS is a principle-based standard. So the PRA, in my view and others' view, are quite helpfully issuing statements and pronouncements in terms of the sort of things a preparer should take in mind. And they have, I mean, prudential regulators discuss matters with standard setters. They do believe that it is consistent with accounting requirements. So I think that the two do dovetail quite nicely, and I do think that as hopefully is coming to light in this presentation, when we start tackling the PRA's letters, they do enhance and they do provide some background and things to consider when applying accounting standards.
Okay, so far as you're aware, Mark, they're not directly in conflict.
I'm not aware of them being directly in conflict, and my understanding is that, as I said, prudential regulators discuss these matters with standard setters. and this is not just the PRA, to be
Yeah.
fair. I mean, it's the ECB and the EBA in mainland Europe, and the messages that they are issuing is largely consistent with what the PRA is issuing as well.
Okay, Mark, before we go back to the slide, I've got another question that's come in. You see, suddenly they've all been energized by Lauren sending them a chat saying, don't forget to ask the question. So this one is, on the basis that payments have been deferred, but interest has not been waived, then they assume that there is no change to the NPV of the loans.
Well, it depends what you're doing, because if you're deferring interest, if you're deferring so I assume this is an amortizing loan. So that means you're deferring the principal, but you're not deferring the interest. So if you're deferring the interest, then there's no NPV change because of that. But if you are deferring the principal to the extent that you're not charging additional interest, then there would be an NPV impact. It would be small, and it depends on the life of the loan and the interest rate and a number of factors, but there would still be an NPV impact. Having said this, I don't think it would be appropriate, given the current situation and the granting of payment holidays, to then charge additional interest to recoup that potential NPV loss. But I mean, a pound in a year's time is always worth less than a pound today, given inflation on time value of money. That's just a fact of life, unfortunately.
Even if we have negative interest rates.
Well, at the moment we don't. And again, I mean, that interest rate would need to be factored into the calculation, and that would actually give you a higher NPV than the carrying amount.
Yeah. Okay, right. Sorry, I'll shut up now. I think we've dealt with the questions. Back to you.
Thank you very much. So, government assistance has a role to interplay with IFRS and UK GAAP accounting for financial instruments. I mean, at the moment, unfortunately, government assistance is widespread around the world that has been impacted by COVID-19, with the forms thereof varying greatly. For example, government guarantees or payments of interest for periods of time. Therefore, thought needs to be given as to how this interplays with financial instruments accounting, which requires careful consideration of the terms of the government assistance itself. And this is required regardless of whether one is applying IFRS 9, IAS 39, or sections 11 and 12 of FRS 102. Government guarantees typically mean the borrower can access funds that they would not be otherwise able to do so. The borrower therefore benefits from the guarantee. However, the lender also benefits from it to varying degrees in case of the borrower defaulting, with guarantees being issued when the loan is originated or on-book loans are subsequently guaranteed. A key consideration is whether the guarantee is integral to the loan or not. Guarantees that move with the loan when it is sold or the loan has been originated in contemplation of the guarantee are typically considered to be integral. This means that the loan and the guarantee form one unit of account, and the effect of the guarantee is modelled into the loss given default, as it does not reduce the risk of the borrower defaulting, but reduces the amount that would be lost if the borrower were to default. Thought needs to be given as to whether the guarantee is off-market or not. If the guarantee is off-market in terms of the amount paid for it, that is to say, its consideration is nil or below what would normally be charged for it, then one needs to think about the effect of IAS 20 under IFRS and Section 24 under FRS 102, which sets out requirements for government grant accounting. If the guarantee is not integral, then it is accounted for as a separate transaction, with the debate of whether the loan and the guarantee are one transaction or two being relevant for borrowers as well. But how you interpret and apply IFRS 9 and IAS 20 or IAS 39 and Section 24 of FRS 102 or Sections 11, 12 and 24 of FRS 102 means that you may end up with broadly the same accounting given the interplays between these standards and sections of standards. The terms of the government grants do need to be complied with from the outset in order for the lender to qualify. One should consider accounting requirements as part of borrower eligibility testing so as that it can be modelled in later, and accounting decisions are to be made off the basis of facts and circumstances, not newspaper headlines. In terms of the payment of interest, this is an operational matter and should not impact the accounting either, regardless of whether one is applying IFRS 9, IAS 39, or Sections 11 and 12 of IFRS 102. That is to say, one should not have a 0% EIR on the loan if the borrower does not pay, but the government does instead in the first year, as the government is effectively doing so on the borrower's behalf. And disclosures of government assistance by lenders is particularly challenging for the very same reason that it is widespread around the world, with the forms thereof varying greatly.
Mark, I'm going to just leap in there with another question because I think it's very relevant to this whole point about government initiatives and government help. So the question says, if they've interpreted what you've said correctly, it's that losses are coming, but they're currently being held back by government initiatives. From an IAS 39 point of view, is the event giving rise to a loss the pandemic itself, and therefore it can be said to have occurred, or does the event not occur until the government initiatives have unwound? I think I get what it's at. I hope I've made it clear.
Yes. I understand that, well, it's neither really. It's when the loss event occurs. So under IAS 39, there's the concept of objective evidence of impairment. And that means you need to have a loss event. So that means when you're aware that that loss has occurred, that is when you should be making a claim from the government because the borrower has defaulted. And I mean, there may be a timing impact in terms of when you go to the government and put the paperwork in. But I mean, it's when the loss event occurs that you're due reimbursement from the government, assuming that all the aspects of the scheme have been complied with.
So suppose it's not necessarily a guarantee type initiative, but the more general one of payment moratoria and furlough.
Yeah.
So you're not, as the mortgage lender, you're not directly claiming from the government, but you're indirectly benefiting, because if it's furlough, the person's still being paid and paying their mortgage, and if it's payment holiday, then they're not paying, but that's cool. So I put the question in that context: is the event that crystallizes everything the original pandemic, or the end of the government intervention, like furlough, for instance?
Well, I mean, again, it goes back to having a loss event.
Okay.
If you've got somebody on a mortgage deferral, right, then they haven't incurred a loss yet. If you don't have a loss event,
okay.
if you then, I mean, if you've got a payment deferral, then there hasn't been a loss event yet. If they're still making their payments while on furlough, then again, you do not have a loss event. So, I mean, you would take into consideration government assistance when it is actually there. I mean, when you come to somebody who's come off the payment holiday and they default, and they're not receiving furlough payments, then there's no government assistance to be taken into consideration when you're determining how much you're going to lose when that borrower defaults.
Okay. Good.
Okay. Let me just check where we're at. Next slide, please, Lauren. Sorry, you've gone one too far. Okay, cool. Thank you. IFRS 9 ECL models have not really been tested in a recession, and they may also overpredict defaults. However, it takes time to recalibrate models, and given how dynamic the situation is, post-model adjustments and overlays are being used. IAS 39 and Sections 11 and 12 incurred credit loss models may also take time to recalibrate as well. These post-model adjustments and overlays have been mainly reflected as increasing the weighting to downsides in the first instance, rather than developing new scenarios. As I said earlier, post-model adjustments and overlays can be affected to inputs and assumptions, parameters, probability weights, and model outputs, with parameters being the exposure at default, probability of default, and loss given default. For March period ends, these post-model adjustments and overlays were mainly affected to probability weights and model outputs, with paper and reverse stress tests being applied in practice. However, there is a question over how much is captured in the forecast, and it is expected that post-model adjustments and overlays will be applied earlier on in the process going forward. That is to say, to inputs, assumptions, and parameters. And remember, one can weight the parameters, or you cannot weight them and then weight the product of them. This desire to reflect the adjustments earlier on in the process is because the governance and robustness of the estimated ECL is stronger the earlier the adjustment is affected, with models therefore again becoming more of value than post-model adjustments and overlays. And also, if you know the model is not capturing something and the post-model adjustment is calculated separately with the total ECL number being intuitive and explainable, then the post-model adjustment can be used to validate the model and its output to an extent. However, this does not apply the greater the use of and the extent of reliance on post-model adjustments is as part of the overall estimation of ECL. And I would just suggest here that we take a short comfort break and we will resume in about 3 minutes' time. As I said, we're just having a short comfort break so people can top up on coffees and tea and water and help yourselves to stay awake as we work through this challenging presentation. We'll be resuming the webinar in about a minute's time. At which point we'll be turning our attention to LGDs and EADs. Okay, so I hope you got your coffee, your tea, your water, and we're now going to go back. On LGDs, we are seeing more haircuts being applied to collateral valuations for a number of reasons. Firstly, there are challenges in obtaining collateral valuations. Secondly, there are also changes in credit risk mitigation strategies. For example, an inability to repossess collateral with less value being derived from the borrower as a going concern under a workout strategy. Operationally, PDs have been embedded, so when assessing for significant increases in credit risk exposures are being pulled back to stage 1 or stage 2, rather than the PDs be recalibrated. The upside of this means that one is applying a stage 1 PD to a stage 1 credit risk exposure. However, there is concern that stage 2 credit risk exposures may be underprovided if and when they move to stage 3, with increased ECL therefore being recognised if a large extent of those credit risk exposures were to move to stage 3, and therefore a large amount of credit risk exposures would need to move back to stage 1 in order for there not to be a large jump in ECL when a portion of those credit risk exposures move to stage 3. But remember, the purpose of stage allocation under IFRS 9 is not to just watch the credit risk exposures move through the stages, but to do something about it, and also focus on curing those that do move. Also, EADs need to be considered given their dependency on customer behaviour. Some draw down more, some less, with there being less prepayments and also prolongation of repayments given deferrals and underpayments. Information after the reporting date is to be used properly, that is to say, to validate whether assumptions were precisely right rather than badly wrong. Next slide, please. We will now be moving away from credit losses for a bit. Fair values are measured based on market participants' view for both financial instruments that are measured at fair value through profit and loss or through other comprehensive income, which includes available for sale category under IAS 39. Markets are becoming increasingly volatile. These markets may also not be as active as they were before the outbreak. The fair value hierarchy level of assets and liabilities may change as a result, with these moving from level 1 to level 2 and level 2 to level 3. As a result, increased disclosure will be required in the financial statements, such as sensitivity analysis and more detailed explanations of valuation techniques and inputs. Distressed sales are to be factored into fair value recognised if it is envisaged that the investment will not be held until its fair value recovers. It is worth bearing in mind that similar to the credit crisis of 2007 and 2008, decline of activity in a market does not necessarily mean that the price is no longer observable. Next slide, please. Risk associated with financial instruments require a fair amount of disclosure under both IFRS and UK GAAP, with these disclosure requirements being set out under IFRS 7 in the main under IFRS, but also IAS 1 when it comes to significant accounting critical accounting judgments and sources of estimation uncertainty, and sections 11, 12, 34 and 8 of UK GAAP. And remember that sections 11 and 12 of UK GAAP have presentation and disclosure requirements for financial instruments. Section 34 has increased disclosures that relate to financial institutions, which a building society is, and Section 8 has your critical accounting judgments and source of estimation uncertainty disclosures. As a result of COVID-19, these may need to be expanded across credit, liquidity, and market risk. The credit risk associated with financial assets may increase, requiring disclosure thereof. Liquidity risk disclosures may need additional thought and commentary, given a lack of liquidity may significantly impact the entity's ability to operate. And currency, interest rate, equity, and commodity markets are more volatile due to uncertainty, meaning some operations will be significantly impacted as a result. For example, entities with floating rate debt will be exposed to cash flow risk, and entities with fixed rate debt will be exposed to fair value interest rate risk. Listed equity and debt holdings will be subject to greater market movements. Defaults and breaches also require disclosure. These increased disclosures will be in both qualitative and quantitative terms. For example, the basis on which sensitivity analysis is prepared and the basis point shift to assumptions thereto may need revisiting and rethinking. We therefore advise you to consider your material financial risk exposures in greater detail than prior years. Financial risk exposures may be impacted in more than one way, and some that were not previously significant may now well be significant. And we are now going to turn our attention to the PRA's letters and statements and articulate how they adhere to accounting requirements and the sort of things that need to be taken into consideration in order to do so. However, Jeremy, it's a good point to stop to see if we've got any pertinent questions before I move on to those PRA's letters and statements.
Mark, nothing has come through at the moment, but I'm sure there'll be several more before long. So just go ahead for that.
Perfect. Thank you, Jeremy. Next slide, please, Lauren. Okay. Sam Woods, Deputy Governor and CEO of the PRA, wrote to CROs on the 26th of March. This is in light of the significant measures taken by governments and central banks to encourage banks in their lending activities and their providing of support to economies. The PRA have stated that these measures are expected to remain in place throughout the period of COVID-19's disruption. This is particularly relevant for March to June year ends and interim financial reports, and going forward, given the fiscal measures commenced before then, and ECL, like most accounting estimates, including incurred credit losses, are estimated on the basis of future cash flows and assumptions about the future, a blight when comparing expected credit losses and incurred credit losses to varying extents. This letter and annex focused on three areas: IFRS 9 accounting and the definition of default, covenant breaches by borrowers, and the regulatory capital treatment of IFRS 9. And while the PRA focused on IFRS 9, some of these aspects also applied to incurred loss models that are used under IAS 39 or IFRS 102. On the point of interim financial reports, there have been talk of regulators comparing what is reported in 2020 interim financial reports to the 2020 annual financial statements. This is to assess the reliability and relevance of critical accounting judgments and capturing of estimation uncertainty. Next slide, please. The uncertainty associated with ECL or incurred credit loss estimates in a COVID-19 world will only be higher. Forward-looking information that reflects the macroeconomic impact of COVID-19 is becoming more available, and thoughts on the overall impact is changing. For example, there has been talk of a sharp V, then more of a U or a skewed V with a longer period of recovery, followed by Ws and some form of L, and now some form of V again. This does present risks to estimating ECL, and incurred credit losses and sound and reliable assumptions need to be used so as to minimize the chance of materially overestimating or underestimating ECL and incurred credit losses. In the current climate, models can overpredict defaults. The PRA has therefore intervened, asking for either models to be dampened, judgment processes introduced, or relative and absolute definitions of significant changed. And also, for that matter, consideration of default definitions to be reassessed as well. The PRA has stated that two aspects are critical to this, and is of the view that the consideration of these aspects adhere to the requirements of IFRS 9. Firstly, judgments do need to be well balanced. Yes, the data is showing that economic and credit conditions are worsening, but public support needs factoring into the modelling, with this being equally applicable under an IAS 39 or IFRS 102 incurred loss model. And as IFRS 9 is based on expectations and forward-looking information, then economic theory needs to be taken into account, given, for example, mean reversion kicks in after 5 years. Secondly, actions to support borrowers may not necessarily automatically give rise to a default under CRR, IFRS 9, IAS 39 or Ifrs 102, or a stage transfer under IFRS 9. Parts of the next few slides are also relevant to preparers who apply the recognition and measurement requirements of IAS 39 or the recognition and measurement requirements of sections 11 and 12 of Ifrs 102. So please bear this in mind as I talk through the slides. Next slide, please. As I said earlier, when it comes to data, economic consensus does lack public sector intervention. And as I also said earlier, there is an acceptance that the ECL impact of COVID-19 in terms of both significant increases in credit risk and ECL estimation itself will be achieved through some form of post-model adjustment or overlay, with this being more so in the initial phases of the outbreak, as the traditional drivers of credit risk may no longer work as they did. For example, government-enforced forbearance needs to be considered in terms of was the borrower or group of borrowers on the edge of stage 1 and stage 2 before COVID-19 or not, or on the edge of default or not, with an overlay needed if they were not. I say this as under IFRS 9, freezing probabilities of default or stages pre the crisis is most certainly not compliant with this standards requirement, and it is probably easier not to suppress current triggers as their operating have been embedded in existing processes. There is therefore a need to manually pull the credit risk exposures back to stage 1 or stage 2. Some other considerations are because IFRS 9 requires assessing significant increases in credit risk over the lifetime of the credit risk exposure, then shorter term exposures are intuitively going to be impacted to a greater extent than longer term ones, given the duration of a recession. This will also manifest in forecasts being shorter term, with the long term trend possibly kicking in earlier. Post-model adjustments or overlays can be used for other economic or political uncertainty, such as Brexit, and care should be taken so as not to double up on these. With this also applying under IAS 39, sections 11 and 12 of Ifrs 102. Days past due is using is relevant, and while one needs to be more granular, a bottom-up approach may not be feasible. Therefore, there is need to identify locations and sectors and consider these on a top-down portfolio basis, as certain significant balances or group of balances may be impacted more than others. We would advise you not to suppress probabilities of default, but suppress days past due or start counting days past due after, for example, a payment holiday. This particular point is being reinforced by the PRA's second DCO letter, which we will come on to soon. We will also advise you to assess relative movement in probabilities of default, with larger jumps being investigated more granularly. I say this as these are more likely to be indicative of credit deterioration as opposed to a lack of short-term liquidity. Next slide, please. The PRA specifically spoke about covenants, given the roles these play in loan agreements, with these points applying equally under expected credit loss and incurred loss models. Similar for forbearance, lenders need to determine whether these are normal or COVID-19 induced covenant breaches. Example of COVID-19 induced breaches are on the screen, and these include delays associated with the provision of financial statements, compliance certificates, and valuations. I like to think of these as being similar to payments not hitting accounts for issues with technological systems, which would not be considered to be indicative of a borrower's inability to meet their repayment obligations if the non-payment is rectified within a specified time frame. And the other examples of covenant waivers are temporary changes to borrowers' reported earnings, suspension of business or other material adverse event clauses, and modifications of audit reports attached to modified and audited financial statements. We will be looking at C in the next slide. However, A and B are particularly pertinent in COVID-19, given the impact of lockdown. Next slide, please. As a result, the PRA understandably asked lenders to consider covenant breaches carefully during the outbreak. This is similar to the underlying theme of needing to determine whether the breach or waiver is due to credit deterioration or a lack of short-term liquidity. The PRA is clear in that COVID-19 induced covenant breaches should be waived. The PRA is also clear in that when doing so, lenders should not introduce new charges or restrictions on borrowers that are unrelated to the facts and circumstances that led to that breach. Also, modifications to audit reports have become the new normal for a while, and people will get used to them. These modifications could take the form of modified opinions, emphasis of matter, or material uncertainties. These again should not automatically give rise to a CRR, IFRS 9, IAS 39, or FRS 102 default, or IFRS 9 stage transfer. On CRR, it is worth remembering that a covenant breach is a possible indicator of unlikeliness to pay, but does not automatically trigger default per se. The thought process that I have just outlined for modifications to audit reports also extends to other COVID-19 induced breaches and waivers of covenants. Next slide, please. A few quick words on the regulatory capital treatment of IFRS 9, and this only applies to IFRS 9. Transitional arrangements are in place whereby the regulatory capital impact of ECL is being phased in over time, and firms could add back 70% of IFRS 9 ECL in 2020. This is only the case if the firm opted into these transitional arrangements in 2017, which the PRA encouraged at the time, and these cannot be opted back into now. If a firm availed of the transitional arrangement, then all aspects of supervision of firms is performed under the transitional basis, and not the fully loaded figures. This includes the determining of capital resource requirements. The EU has, on the 27th of June 2020, issued amendments to CRR in response to COVID-19, which is colloquially known as the CRR Quick Fix Package. In accordance with the European Union Withdrawal Agreement Act, the CRR Quick Fix Package applies directly to PRA-regulated firms. This means that, for relevant provisions raised from 1st January 2020, the CET1 add-back percentages are reset from 70 to 100% for 2020. In subsequent years, the add-back percentages are 100% in 2021, 75% in 2022, 50% in 2023, and 25% in 2024. And I'll just take a short pause here, Jeremy, to see if we have any more questions from the audience before I move on to the second PRA letter.
Not at the moment, Mark. As I said, I'm sure a few more will come, but I think just quickly double checking while you take a swig. No open questions. So on you go.
Thank you very much, Jeremy. Next slide, please. Sam Woods, Deputy Governor and CEO of the PRA, wrote another letter to CEOs on the 4th of June 2020. This is primarily in response to borrowers coming off of payment holidays that were granted at the outset of COVID-19. It focuses on the implications of the exiting of those payment holidays in terms of IFRS 9 and CRR, with parts thereof being relevant under IAS 39 and sections 11 and 12 of FRS 102. It also includes some commentary on May's monetary policy report and May's interim financial stability report that were issued by the Bank of England. The monetary report includes a COVID-19 scenario. While this is a plausible scenario, it is in itself not a stress scenario. The stress has been applied through the actual modelling of the provisions, not the scenario itself. For example, the fall in residential house prices and commercial real estate prices is only half of that of the last annual stress test. The scenario therefore represents useful data points that are reasonable and supportable, but does not represent a flaw in terms of a downside scenario. This is a good example of how data and information is not to be used mechanically. The Financial Stability Report comes with another use warning. It is a desktop stress test that did not involve submissions of data by lenders to the PRA. Its purpose per se was to assess the adequacy of capital of the UK's largest lenders and not estimate ECL in accordance with the requirements of IFRS 9. Sizable ECL is coming though, with the quantum and timing thereof being uncertain. So again, useful information, but please exercise care when using. For example, consider the 4 pages worth of notes that are associated with this desktop stress test and their relationship with your books or books of business. There are 4 areas in the second letter that we will look at, and these relate mainly to payment holidays and associated matters, with the messages associated therewith being relevant to IFRS 9, IAS 39, and FRS 102, sections 11 and 12 preparers to varying degrees. Next slide, please. But first, the PRA reiterates that the messages of its March letter are still very much relevant, and that is still the case today. For example, the need to assess stage transfers and model ECL using reasonable and supportable assumptions, factoring government assistance and economic theory. Of particular relevance to payment holidays and associated modifications is whether these are now indicative of credit deterioration or still short-term illiquidity. On the rebuttable presumption that there has been a significant increase in credit risk if the repayments are 30 days past due and a default if the payments are 90 days past due, the PRA notes that COVID-19 related deferrals do not trigger the counting of days past due for these backstop tests. And I note that some of you may be applying a 90 days past due test under IAS 39 or sections 11 and 12 of FRS 102, or even 180 days past due test for retail mortgages. This is to say that the counting starts when the COVID-19 related deferral ends. If deferrals are not being tailored to borrowers, but granted across the board as is, then it is more likely that these are not reflective of those borrowers' individual circumstances. Having said this, the PRA is not expecting everybody to resume repayments when the initial, for want of a better term, payment holiday ends. So much so, given the extension of furlough, the FCA has issued guidance on borrowers who are now taking payment holidays for the first time this year, or a second or a third. Missed payments via reference to an agreed or revised payment schedule still warrant consideration as to whether they are indicative of significant increase in credit risk and credit impairment or default. Next slide, please. Furthermore, it should not be assumed that a borrower that was granted an initial payment holiday and was at the point in time to still be in stage 1 is to remain in stage 1 if they are granted a second payment holiday. There is an expectation that more loans will move to stage 2 and stage 3 as there is a granting of further payment holidays, but that this would not apply to all of them. The same logic applies to other modifications, for example, term extensions. The more these are tailored to borrowers' individual circumstances, and the less they are taken up, then the more likely that this is being granted as a result of credit deterioration. This is because the lender has more information on the borrower and needs to regularly consider this, with this being relevant under IAS 39 and sections 11 and 12 of FRS 102. It is worth pointing out that IFRS 9's definition of credit impaired financial assets incorporates the concept of granting of concessions that the lender would not have otherwise considered. The PRA therefore advocates and sets out the basis for a holistic assessment that looks beyond the use of days past due for assessing significant increases in credit risk and default, and differentiates based on the facts and circumstances of borrowers or groups of borrowers, under which information is used for groups of borrowers in the absence of information on individual borrowers. This only holds true if accounts in question are not material in isolation. And on the information, different credit risk exposures are being impacted in different ways. While there are some upright decreasing question marks as to the extent that information can be acted upon in terms of retail and consumer credit portfolios, there also remain question marks over the ability to process all of the information that is available when it comes to corporate exposures, given they are provided for individually and manually. The information on retail and consumer credit portfolios is becoming more extensive as further payment holidays are availed of, and we'll elaborate on this in a moment's time. The PRA's framework for assessing impairment has 4 elements. Firstly, consideration of economic conditions. For example, is the group of borrowers employed in a sector or reside in a location that is more adversely impacted by the outbreak? Secondly, using historical information on the borrower's payment behavior. For example, is this a one-off or has it happened before? Thirdly, using new information that has been obtained through the payment deferral request process. It is important to point out here that the FCA guidance does not require lenders to gather borrower-specific information before or at the time a deferral is made available, and there is no expectation that they will do so. But they may still obtain information, and this cannot be ignored. For example, the borrower may have voluntarily stated the reason for requesting the further payment deferral, or have provided data on reduced income levels, and this therefore needs to be taken into account. Fourthly, applying judgment where individual information is not available. This includes using segmentation so as to identify groups of borrowers that have suffered a significant increase in credit risk, and extend this to gathering information for a representative or random sample of borrowers, and then inferring results to the existing segments or newly created more granular segments, given COVID-19 to fill gaps in data. With higher risk pools moving to stage 2 or stage 3, or into default under IAS 39 or sections 11 and 12 of FRS 102. Next slide, please. In terms of payment deferrals and days past due, the same holds true for unlikeliness to pay indicators under CRR, with these being based on agreed and revised payment schedules. And to reinforce the message, lenders are to use information that they have, with no expectation that they will investigate individual borrowers' circumstances. But again, the more lenders tailor what they offer a borrower, then the more likely that they will be classified as a distressed restructuring under IFRS 9, IAS 39, and sections 11 and 12 of FRS 102. The need to make the distinction remains as to whether the borrowers are not resuming full repayments because of COVID-19 or because they are in more long-term financial difficulty. The PRA acknowledges that this is not easy. One parting thought on payment. Yes, Jeremy?
Sorry, can I just, because I think it's exactly relevant to that point, bring in a question we've just had from the
of course,
from the delegates. So this is about the retail mortgage book situation in particular, which obviously is where all our members are concentrating. So the question is, what practically do you suggest is done on a retail mortgage book where there will be no indications of SICR other than the fact that a COVID payment deferral, a payment holiday was used? So the PRA steer is not to use the fact that there was a COVID payment holiday as a SICR, but in the absence of anything else, what should we do? Because ignoring it seems wrong. I hope I've got that.
Yeah, I understand the question. I mean, it all goes back to the take-up and the tailoring of the payment holidays. So when we were in March, basically, I'm aware of a number of instances whereby you could just phone up your bank or building society, request the payment holiday, and you'd get it.
Yes.
I think the point here is that in itself is not indicative of SICR. or default for that matter.
Yeah.
I mean, now when we wind the clock a bit forward, we come to second payment holidays, and a fact of the matter is that a number of people are not taking them up. So that means with the second round of payment holidays, you need to look harder at them and say, look, for this borrower or groups of borrowers, is this indicative of a significant increase in credit risk? And it goes back to that holistic framework that I was talking to a couple of slides ago. So it's a case of thinking about it, look, in what sectors do these borrowers operate in? Do they operate, for example, in the hospitality sector, which is on shutdown at the moment? And I mean, it's a case of going through that thought process. Also, another thing to be worth bearing in mind is that the base of the payment deferrals themselves as an absolute number is decreasing over time. I'm minded that the FCA issued guidance on additional payment holidays, because if we think it through, March would take you to June, June would take you until September, and now clearly if somebody's asking for a third payment holiday, my understanding of what the FCA is saying is, look, you kind of need to draw a line under that, which implies that you would have a significant increase in credit risk if that person is requesting a third payment holiday. So I think the main lessons are, if the payment holiday, the initial payment holiday was taken in March, given the widespread take-up of that and the lack of tailoring, then that is probably indicative of short-term liquidity rather than credit deterioration. However, if people are now availing of payment holidays, particularly second or third payment holidays, then the lender really needs to take a step back and saying, look, is this not indicative of credit risk, or is it short-term liquidity? And with time, and we're seeing that now with second and third payment holidays, it's more likely to be indicative of an increase in credit risk than it is short-term in liquidity.
Okay, that's great, thanks.
Okay. And as I've said, I mean, payment deferrals, the base thereof is reducing. That is to say, less people are taking up further payment deferrals. Next slide, please. The PRA issued a statement of the 26th of August in response to the FCA's updated guidance on mortgage payment deferrals. Tailored forbearance when the borrower cannot resume their repayment obligations in full, either through repayment or capitalization, means careful consideration, with the same pre-COVID-19 considerations being needed in terms of whether this gives rise to significant increase in credit risk, default, or credit impairment. And this is the case regardless of whether one is applying IFRS 9, IAS 39, and sections 11 and 12 of Ifrs 102. The PRA has reiterated that its previous guidance remains relevant, particularly where payment deferrals are still being widely used, which is the case in other parts of the world. And that would be relevant for banks with overseas operations, but I understand that building societies do not have such exposures. The PRA also reiterated that other aspects remain relevant, such as the holistic framework assessment from the June letter, treatment of borrowers who breach covenants from the March letter, and the use of post-model adjustments and overlays. And Jeremy, I'll just take a pause here to see if there are any other questions from the audience.
Not at the moment, so...
Okay. Next slide, please. And this slide summarizes some of the key considerations that we have talked through, with most of it being relevant to IFRS 9, IAS 39, and Ifrs 102 sections 11 and 12 preparers. Clearly, thought needs to be given to the incorporation of forward-looking information, macroeconomic variables, multiple scenarios, and probability weightings. Definitions of what constitutes significant increase in credit risk and default need some consideration, with definitions being amended as a result, with focus being more on default definitions than significant increase in credit risk the longer a recession lasts. The combination of these points will give rise to the increased use of post-model adjustments and overlays, which still need to be substantiated and justified. That is to say, they are not free passes, and stakeholders will start to benchmark the use of these. In practice, borrowers may be less reluctant to repossess property, lenders may be less reluctant to repossess property, and there will be difficulty in obtaining uncaveated new collateral valuations to estimate loss given default, as we are seeing that valuers are typically including more caveats and modifications when they are issuing a view on what the value of collateral is, while the likelihood of guarantees being called is heightened, with ECL thereon coming into play. And lenders and borrowers will modify the terms of their loans, which will have measurement implications generally, but credit loss implications as well. Governance processes are fundamental to all of this in terms of underpinning how well IFRS 9, IAS 39 and FRS 102 are being applied during the outbreak. And also, I noted earlier, one of the delegates said that they thought that the PRA statements and accounting standards don't seem to correspond. So I'd be happy to take questions on that when we go to the formal Q&A session as to where they think that they do not correspond. Next slide, please. This slide also summarizes some of the key considerations, with governance starting this list. Accounting needs to reflect what you do in practice and change accordingly when you change how credit risk is managed within your institution, with this including consideration of changed exit strategies. High impact, low probability scenarios are to be captured, as is the case with any sort of uncertainty. The conditions of schemes and changes thereto need to be understood and reflected in credit risk modelling as quickly as possible as part of changed credit risk management practices. Borrowers are to be treated fairly. The basis on which payment deferrals and further payment deferrals and other modifications are provided to borrowers need to be considered at a more granular level. For example, who, what and why, with more differentiations being made. And the information that is used to make those credit risk management decisions need to be captured and factored in assessments and modelling more generally. Fair values will be affected to varying degrees. There is also an overall need to ensure that circumstances are reflected in the right way rather than have unintended consequences when we come out of this. And finally, please remember to be transparent in disclosures to the market, particularly when it comes to critical accounting judgments and source of estimation uncertainty in quantitative and qualitative terms. Next slide, please. There are resources on both financial instruments accounting and reporting and COVID-19 on our UK and global websites. Next slide, please. There are my contact details on the screen should you want to discuss anything that we have covered today or any accounting, financial reporting or corporate reporting matter further, with corporate reporting being the front half, such as Section 172 statements, strategic reports and directors' reports. But may I remind you that the slides of this webinar will be made available, so you'll have them to hand. Next slide, please. And on that note, I thank you very much for your kind attention. I hope that you found this useful and that you and all at your building society continue to keep safe and stay well. We will now take a few more questions from the audience. Jeremy.
I've got one, which is just a fairly general one, while others sort of get going. And it picks up on something you said in a couple of slides back, that you not to do things now that create unintended consequences later. Just generalizing that, I wondered, is there a sense that the treatment, the slightly unusual treatment under accounting standards that's happened for the response to COVID, do they set a precedent which it'll be difficult to shake off, and that in future, when something bad happens, people will say, oh, we did this during COVID, so we can do the same thing again?
I don't think that you're going to get, I mean, the whole point of this is that you need to, I mean, as I said quite early on in the presentation, Jeremy, I mean, IFRS are principle-based standard, and you need to apply judgment in applying them. I mean, the point around unintended consequences is, for example, you may need to pull back exposures from stage 3 to stage 2 or stage 2 to stage 1. I mean, that's an example of a post-model adjustment. So you get a answer that reflects economic circumstances. I mean, but then the point around unintended consequences is when we start to come out of this, just like models are over predicting defaults, now they may be under predicting defaults. So you would then have the converse whereby you may need to pull from stage 1 to stage 2 and stage 2 to stage 3. And I think that those are the considerations. I mean, judgment works both ways, both in terms of credit defaults, the amount that you estimate. So I think it's a case of applying good and sound judgment, both when we're in COVID-19 and when we come out of it. And that's what's very much required at the standard. Hopefully that's answered that question.
Okay, thanks, Mark. I'll just see if we've got any others from the audience, and I've got one or two to hand. Okay, let me just get onto one of these. So these are sort of going back over what you've covered over the presentation as a whole. Let me just find the one I wanted. It's got on the wrong thing. Yeah, just one thing to go back to. You did mention cash flow hedge accounting and the impact, whether there's any impact on fair value hedge accounting. I have half a feeling you wanted to come back to that later on in the discussion. Did we clear that off?
Well, I mean, I think so, in the sense that okay. I did speak about cash flow hedge accounting.
Yeah.
But I mean, the reason why we did not touch on fair value hedge accounting, and it's a good point because I note that a number of the BSA's members do apply fair value hedge accounting, is if we think about it, cash flow hedge accounting results in deferring the gain or loss on the derivative in other comprehensive income. However, fair value hedge accounting gives rise to a broadly equal and opposite adjustment,
okay,
the carrying amount of the hedged item vis-a-vis the hedging instrument. So if the fair value of one decreases one way, then it is probable that the fair value of the other will increase the other way, possibly to a lesser extent than before the outbreak. So less of an impact is expected on fair value hedge accounting relationships.
Okay. One other question, which again goes back to, is relevant to people who've got an incurred credit loss model. So somebody who applies an incurred credit loss model but does so by estimating incurred PDs, probabilities of default, and LGD, loss given default. In that situation, how do they factor in government assistance to the loan loss provisioning process?
Yes. I mean, this is not an area that's been debated widely under IS 39 or IFRS 102, but I will provide some thoughts by inference to IFRS 9. I mean, firstly, one needs to assess whether still needs to assess whether the assistant is integral or not integral to the loan asset. If integral, then it is captured in the estimation of credit losses. If it is not integral, then IS 37 or Section 21 applies to the reimbursement asset. An example of a non-integral credit enhancement is the provision of a financial guarantee contract by a third party to the lender that was not entered into as part of contemplating originating the loan and is separable, that is to say, it can be transferred separately. If captured in the estimation of incurred credit losses, then current thinking is that this would reduce the loss given default and not the probability of default, as the risk of default associated with the borrower does not decrease in terms of the schemes we have seen. This is because the borrower still needs to default for the government to participate in the loss. And this kind of touched on the point that we were speaking about earlier in terms of the loss, needing to incur a loss. So if a parameter-based approach is being used rather than an individual assessment, then you would capture that reimbursement asset in your loss given default. If an individual assessment is being used and it's integral, then I think you'd reflect the recovery of the guarantee in the expected cash flows. That is, the cash flows are mitigated to an extent.
Okay, thanks, Mark. I know we've got to finish pretty well at 11:30 sharp, so I have one final question from the delegates, and it goes back to this question about payment holidays and NPV. So to eliminate that issue further, in general, interest continues accruing during a payment holiday. So I would have thought that as long as the interest rate equals the discount rate, NPV should not change, at least as long as fees and incremental costs are ignored. which naturally may impact EIR, but this could go either way.
I agree to the extent that interest continues to be accrued during the payment holiday. Then you would not have an you should not have an MPV charge, but you would need to factor in other aspects of the EIR, because we need to remember, for example, when you've got a fixed rate mortgage, you need to capture those as well. But to the extent that you are still accruing interest and you haven't waived the accrual of interest, then I don't think that you would have an impact on your MPV.
Okay, thanks, Mark. Right, it is now 11:30, so we've been at this for 90 minutes and time to draw it to a close. Just a couple of brief remarks before we switch off. So first of all, big thank you to Mark, who's done a sterling job in going through this quite technical and difficult area, and I hope it's been useful for all of you. And just a reminder that the slides and the recording will be available before a few days. We just need to get them ready for being put on the website. So you'll be able to go over the material both through the slides and through, if you want to, listening to the webinar. And I think we've dealt with all the questions that came up, so that's good. Beyond that, I think all I have to say is, having thanked Mark, thank also Lauren, who's behind the scenes, whom you haven't been able to see yet, but she's kept the techno side going very effectively throughout. So thank you, Lauren. So thank you to the whole BDO team. Glad you could all take part remotely and find it useful. Welcome any feedback. And I think Mark has given you his contact details. So if you want any follow-up, you can go through to him. So with that, without more ado, I'll close this event. Enjoy the rest of the day, stay safe, and see you at another webinar before long. Okay, bye everyone.
Bye everyone, thank you.